Welcome to the Create More Value podcast, sponsored by Fortuna Advisors, the boutique shareholder value improvement advisory firm. Create More Value is a series of conversations with senior executives, board members, investors, and other experts that have overcome challenges to create exceptional value for their companies. There are many ways to drive value, so we cover a wide range of topics. I am the host, Greg Milano, founder and CEO of Fortuna Advisors, and I hope you enjoy the conversation as much as I did. I would like to welcome my very good friend and former business partner, Don Chu. Thank you, Don, for joining me on our Fortuna Advisors podcast, Create More Value.
Thanks, Greg. I'm honored to be here.
Don Chu is the editor-in-chief of the Journal of Applied Corporate Finance, which in my opinion is the top journal in the field. Don is a master at taking complex theories and perspectives and making them understandable and accessible to those both within and outside the academic community. I sit on the journal's advisory board and have had about 10 articles published in the journal since Don and I met back in 1992. We are not here today to speak about the journal, however, or even about Don himself. This April, we lost one of the great thought leaders of all time in financial economics, Professor Michael Jensen. Don knew Professor Jensen very well and is currently preparing a special issue of the journal to honor Jensen's life and work. I personally met Jensen many times, and his work had a profound impact on me and how I think about the business world. Jensen graduated from the University of Chicago with a PhD in 1968, having worked with both Merton Miller and Eugene Fama, and went on to an illustrious academic career at the University of Rochester and then Harvard University, before spending almost a decade at Monitor Group, the strategy consulting firm that is now part of Deloitte. As a symbol of his impact, it is notable that in 3 previous episodes of this podcast, Jensen was mentioned in relation to 2 of his best-known works, the 1976 paper he co-authored with William Meckling, Theory of the Firm, Managerial Behavior, Agency Costs, and Ownership Structure, and a 1990 Harvard Business Review article, CEO Incentives, It's Not How Much You Pay, But How, which he co-authored with Kevin Murphy. Don, before we get into his work, what was Michael Jensen like as a person?
I've really never met or worked with anyone quite like him. He had just an amazing appetite for ideas. He thought about how things worked, and then he tried to understand how they worked. And once he did that, then he could always find a better way to do something. So if you go back to the University of Chicago, his PhD thesis was studying the performance of mutual funds in order to determine whether or not professional investors actually outperformed the averages so that they would justify the princely fees that their investors paid them. And lo and behold, he found that the 80% of professional fund managers failed to outperform the S&P 500. And those that did happen to outperform in a given year had at best a 50-50 chance of doing it the next year. So this basically buttressed the University of Chicago theory of efficient markets, and then it really led to index funds. And then from there, he went on to develop a method that forms the basis for the event study. That is, how do we determine the market reaction to an event? And we look at the stock price reaction, and we control for market movements surrounding it. We control for the risk of the security. And working with Gene Fama and Dick Roll, Mike basically pioneered that method. And then from there, he goes on to the University of Rochester, meets Bill Meckling, and then they decide that the form of the corporation as we know it couldn't possibly work the way that we think it does. All of corporate finance theory up to that point was premised on the idea that corporate managers work for their shareholders. They're reasonably good agents for their principals. But as Mike said, Mike and Bill thought about the black box of the firm and said, this is not who managers are. They have a fundamentally different set of interests from those of their shareholders, and the public corporation has to find a way to unify those interests. And so he codified this and wrote the most famous paper, the agency cost paper, that's been cited 130,000 times. And they figured out how the corporation worked. And I should take a breath here, and if you want to insert, but I will go on in this, flood.
Well, why don't we take what you've introduced the term agency cost. Why don't we spend a minute just on that? So tell us what agency cost is.
Agency costs are conflicts of interest and incentives between two sets of parties. So the important one is between corporate managers and the shareholders whose interests they're supposed to be serving. Well, Jensen showed that managers really, the long run maximization of shareholder interest is only one of many concerns they have. They want to be pillars of the community. They want to protect their jobs. So what they really want is they want growth, and they would like to have diversification too. And shareholders don't need those things. Shareholders just want to earn high rates of return. So
Mhm.
Jensen and Mexling's challenge was to say, okay, how does the corporation solve this problem, this conflict of interest between managers and shareholders? And they said, well, there's a set of external mechanisms. There are product markets. You have to get people to buy your product. There are labor markets. Managers want to get their next job, so they have to protect their reputations. And then if those things fail, there are takeover markets that will basically ensure that managers do their bidding. And then there are internal governance mechanisms such as boards of directors, audited financial statements, and incentive plans, the kinds of things that Greg and his firm do so well in designing. So the question is, how do those factors end up controlling managerial behavior? And the way Jensen and Meckling left it in 1976 was, well, the fact that the corporation predominates in every developed economy must mean that the corporation is working. So our governance system is a success. But at the end of the paper, they said, but hey, how do we explain large corporations in which managers own next to no shares? How does that really work? And so if you looked around you in the late 70s, corporations lost half of their value during the conglomerate era.
Mhm.
And so Jensen and Meckling really put their finger on this development that should have been of concern to shareholders. And what they really pointed ahead toward was what maybe one of Jensen's most important concepts was the market for corporate control, which
Mhm.
he developed with Henry Manny at the University of Rochester. The idea that all public companies are always for sale. If they don't do a good job, then there will be investors that will come along and ensure that they do the right thing.
Mhm.
And let me stop there and take another breath. And if you want to,
Yeah, I mean the spirit of the market for corporate control, Michael really loved leverage buyouts. He thought they were a superior form, and he spoke a lot about private equity in general, and felt
yeah.
that was a preferred organizational form. Why did he think LBOs were so good?
Well, he was comparing them to conglomerates, and he said LBO associations had the identical collection of assets that private equity firms has. They were diversified, but they basically set up every corporation on its own narrow bottom, and then they basically ensured that the ownership of LBOs was intensely concentrated. You basically all it was owned by all the largest shareholders of the firm effectively sat on the board, so that you didn't have any communication problem that a public company has. So you have concentration of incentives, ownership, and then you have high leverage. You use the high leverage to concentrate the equity in the first place. And it also had the effect of forcing the free cash flow out of the firm. And then you have operating managers with large equity stakes in the firm, which corporate conglomerates generally didn't do. I think Jack Welch actually did it under GE, if I'm not mistaken,
Mhm.
but in general, that he just foresaw private equity supplanting the public corporation in any kind of mature industry, and in my view of the world, that has clearly come to pass, and it's begun to expand to growth areas as well.
Yeah. To me, there are two aspects of it that I think played right into his thinking. One is this in concentrated ownership. Management tends to have a big stake in their success that doesn't get diluted the way a lot of modern executive compensation in public companies does. But the other thing was taking the cost of capital and converting it from a theoretical construct to a cash construct. The
Yeah,
having all the debt, especially back in the 80s when he was writing a lot about this. I mean, there were companies that had 95% debt,
yeah,
and interest rates were much higher back then, even than they are now. So the big cash payment you had to make every month or every quarter for interest and principal caused a lot of discipline that wasn't there before. And I think that was another side of it, as well that he talked about.
Yeah.
So going on from there, I really love the title of the 1990 Harvard Business Review piece, "CEO Incentives. It's not how much you pay, but how." I quoted that title when I was speaking at a Total Rewards conference earlier this year, and while I said the words, somebody in the audience mouthed them along with me. So the fact that some random HR person at this conference knew of this paper was very impressive to me. But what were his general views on executive compensation?
Well, they were shocked at how little corporate managers were being paid in the late 70s. He said they were paid like bureaucrats,
Hmm.
and they really their pay also varied with the size of the firm, not with profitability. And so their incentives to maximize value, or to take an acquisition, for example, that would actually pay off as opposed to just enriching their own pockets, was really de minimis.
Hmm.
They said basically for every $1,000 of shareholder wealth, a manager would get paid $3, and that was just unacceptable. And so Jensen and Murphy's paper ended up, I understand, becoming a major force for Jensen was identified the major advocate for increases in CEO pay,
Hmm.
and it really and a lot of it was stock and stock options.
Yeah, I always think of it as it's not just the amount of pay. It's also what does the executive need to do to earn another dollar? Does it always require them to do the right thing to get that dollar, or there are lots of ways they can get that dollar that are not aligned with shareholders? I think the the amount of pay was important, but also the mechanism of how you got that extra dollar. I always felt was very important to him. I just not to get off the topic too much, but I'll always remember the one conference we had in Italy where he came to speak, and he started his presentation by saying, "If it's a percentage, it's wrong." And I remember just being shocked that he was so bold in his saying. But what he meant was percentages just measure quality, not quantity. Percentages like return on capital or profit margins or what have you tell you something, but they don't tell you everything, because if you only cared about a percentage, you would never grow. Once you got to a certain profit margin, you would just sit back and say, okay, I'm happy. You would never invest in anything else. And you needed a dollarized measure.
Yeah.
Um, you
And
know,
that's
and
why he was such a fan of the measure of EVA,
that's right. And
which he
that
described as the best single period measure of performance ever devised.
yeah.
And then Peter Drucker did him one better and said this is the first practicable measure of total factor productivity ever developed. And I think that's an incredibly important idea, which macroeconomists have just not gotten their arms around.
Hmm.
Their concept of labor productivity doesn't include investor capital as a key input.
Yeah.
And so you're not measuring economic progress in a way that people like Jensen found useful.
Yeah, I agree. I agree. And I think going back, of course, when I met Jensen, I was working with you. We were at Stern Stewart, the EVA company at the time, and it was an EVA Institute event I referred to a moment ago. But yes, his view of needing a comprehensive measure that captured growth, it captured cost efficiency, it captured capital productivity, all in one measure. It was really important, and it certainly helped the adoption back then of EVA and other measures of economic profit. Has all this worked? What would you say that the initiatives that he strove for in terms of trying to get companies to be more efficient, more productive with their capital, and so forth? Would you say it's worked? Have we seen improvements because of his work?
I think Jensen, again, I think the most important concept he developed was the concept of the market for corporate control.
Hmm.
And the argument there is that investors, you can't rely on managerial expertise and goodwill for companies to create value over time. You need investors, exerting discipline, but wise and far-sighted discipline. But nevertheless, they have to be there.
Hmm.
And if you look at shareholder rates of return in the last 40 years, have averaged an astonishing 12% a year in this country. That's
Hmm.
probably double any other country.
Hmm.
And if you ask me, that is the source of national wealth.
Hmm.
These a vibrant corporate sector is what creates jobs and leads to public welfare in all kinds of ways. So, and the fact that private equity has just dominated public equity. Private equity's done even better than
Hmm.
public equity. Both of these are astounding
Hmm.
confirmations of Jensen's two most important arguments.
Yeah, no,
So,
I agree. I agree totally. Okay, so let me take a step back to something I was going to ask earlier, and then it slipped my mind. So, one of the things he wanted was to temper. Back in the 70s, there was a big emphasis on conglomeration and growth at all costs and so forth. And I think that laid the foundation for his work to say that unfettered growth is clearly not the answer. But why do managers always want to grow? And why did Jensen believe that growth needed to be tempered?
well, growth is the only kind of story that the New York Times will accept. Most people think of all growth is good.
Hmm.
Anything that's not growth is bad. I mean, it's just a popular conception. And if you're a politician or a policymaker, no one wants to be holding up their hand saying this business over here has to shrink so that
Hmm.
this one can grow.
Hmm. Hmm.
Jensen Schumpeter said it in terms of creative destruction, but what Jensen did was show how the financial system carries out Schumpeter's process of creative destruction. Jensen's system squeezes out excess capital from dying industries and gets it into the vital industries.
Hmm.
And it's hard to detect that process. A journalist can't find it. But so, and that's, and no manager wants to be the guy shutting down an industry. That is why private equity gets such a bad name, because private equity does a lot of the cutting. No,
Hmm.
that all gets done out of sight, out of the public eye,
Hmm.
because the public is so resistant to the idea that any kind of company has to be run for long run profitability as opposed to job growth. Countries like Japan and China are completely believe the corporate objective function is full employment. And
Hmm.
valuation, if considered at all, is way behind. And I would argue that is the cause of Japan's 30-year recession, and it is much of the cause of China's problems today. There is
Hmm.
zero productivity. That the rates of return on the Chinese stock market since 1993 in its modern era are minus 5.5%. You don't get savers don't get rich
Hmm.
on minus 5.5%. So they invested in these banks, which then invested in all kinds of junk that makes our mortgages look great. So
Hmm. No, that's
getting
really
out of
great.
my depth here. Okay.
No, no, that's good though. It's an interesting comparison. I think when you think about the success of the U.S. markets and how that kind of proves out that we've had productivity gains and so forth, it really is stunning when you think about the sources of that growth because you have a lot of old world companies that have improved performance and generated good share price performance, but out of nowhere in this environment we have in this country came companies that nobody heard of 20, 30 years ago that have been just wildly successful, the Microsofts, the Apples, and Google and so forth. It's really amazing that you can have an environment where people are focused on capital productivity, on efficiency, and also on innovation and growth at the same time. I think it's quite impressive, and I think that's a lot of what's behind those fantastic returns. So, along those lines, as we transitioned from more of an industrial economy to more of an information era, information age economy, has that caused the need for Jensen's principles to be more important, less important, the same importance? Has there been any impact because of the change, the modern business models and so forth? Has that impacted the usefulness of Jensen's perspectives at all?
I think in some ways it makes it more important, but we can no longer rely on accounting information to tell us how profitable a company is. So
Hmm.
we know from Baruch Lev's book, The End of Accounting, that the statistical correlation between long run long run earnings and stock prices has gone from something like 50% in 1970 to negligible today. So what it means is that managers have to find a new way of communicating with their investors. And to do that, you need very smart investors,
Hmm.
and you need the investors to be able to talk to what you need concentrated ownership or smart owners. And what we've seen in the success of the Magnificent Seven is that companies have been able to create value without much in the way of producing accounting earnings. That you
Hmm.
have a different set of metrics and in which which enable managers to signal to investors that they are investing in their future. And it's Jensen's active investors, these smart people with large positions
Hmm.
that basically it gives managers people to communicate with. And by the way, if those investors become unhappy with your performance, take a company like Salesforce. When Salesforce went from 100 to 300, and it was probably the most popular company in the world, the wokest company in the world. And then when they made two very bad acquisitions and way overhired, the stock price went from 300 to 130.
Hmm.
And then what you found was five activist investors were camped out in the boardroom.
Hmm.
And Paul Elliott from Singer Management, the investors started saying, "Hey, we are now going to show up, and we're going to help direct the flow of capital. You
Hmm.
cannot continue wasting our capital." And that stock price is now damn close to 300 again.
Hmm.
And
Hmm.
that is Michael Jensen.
Hmm.
It is Jensen's active investors stepping in to make sure managers do the right thing. Even if they have the biggest building in San Francisco, even if they call their company the Ohana, the family, it's the investors run the show. That's the lesson. Until, managers run the show until it gets out of line, then
Hmm.
investors as the residual holders. And that was Jensen's point. The investors have to have the control. Yeah.
Oh, that's really great. So there's one last question I want to ask you. So he talked at times about leverage and dividend policy and stock buybacks and different sort of financial things that companies do. What were his views on those policies, and how did that relate back to his core principles?
Well, I mean, Jensen's focus on the importance of exit, it means that companies need to pay out their excess capital. And dividends and buybacks are all different ways of accomplishing that objective
Hmm.
of getting your capital out so it can be reinvested. In fact, one of the most important study I've ever seen is Mark Rose at Harvard. He looked at the total distributions by U.S. public companies over 30 years,
Hmm.
and they were almost matched, to a remarkable degree by new capital raisings by smaller than S&P 500 companies. So what you have there is a massive recycling of capital out of large maturing companies into the true producers of growth. I mean,
Hmm.
it is a incredible process of ferment where the company, far from an admission of defeat, paying out dividends is you're giving the money back into this cornucopia, and which will crank it out and then get it in front of the new growing companies. And to me, it's a wondrous thing. I just and Jensen that was Jensen's great understanding how technology works hand in hand with financial markets
Hmm.
to take excess from one place and move it to opportunity in another.
Yeah, no, as you know, I've written a bit about this as well, and I feel like that what you just described, that virtuous cycle of capital being returned to investors so they can then find the next up and coming Apples and Googles and what have you to put the money into, is so much better for the economy than the original company keeping the capital to try to invest it in whatever they're doing. And I think
Which
that's
is
one.
the Japanese system, by the way. Stock repurchase was actually banned until about the year 2000. The Japanese
Mhm.
actually sent a delegation to Stern Stewart. They interviewed me about what I thought about the social wisdom of stock buybacks.
Uh-huh,
Do you
uh-huh.
think they're a good thing? And the Japanese law says no. The company owns the cash,
Hmm.
which belongs to the employees. The
Right.
cash is the proper, and that is that is the view of 90%, 99% of mankind. Dividends and buybacks are evil.
Right, right,
And
right.
so the degree of ignorance about the financial illiteracy in this country is just staggering.
Yeah, no, I
I should
agree.
not go any farther than that.
Okay.
But I also agree, Greg, that that your and Michael's concern about whether or not companies buy back their shares at too high a price is, to me, a second order. The important thing is the companies pay it out. And if they happen to pay out too much to selling shareholders, I'm okay with that. I mean, in the grand scheme of things, I just want them to pay it out. And if the sellers happen to be smarter than the buyers, well, I can live with that. So, people like to comment on Mike's late career integrity crusade. He tried to turn integrity into a factor of production. And, a lot of us were very intrigued by that. He did a week-long seminar at the University of Rochester. And my boss, Linda Riefler, actually incorporated elements of his integrity program into the Morgan Stanley framework. So she was quite taken by this. But I really feel like, Mike wanted to be everything. He wrote a paper for me called The Nature of Man. And it just, I said, Plato and Aristotle did that 3,000 years ago. He said, but they didn't understand the problem. I do, and the same thing with integrity. He would tell you how to run your family. And integrity means saying what you're going to do. If you don't do it, then the next day you have to come back and say why you didn't do it. And he believed that principle applied to the dialogue between investors and managers, between boards and managers, between board managers and their underlings. Everyone had to make big commitments every day, and then and you're going to fail when you make these commitments. Then you have to come back and say what went wrong. And see, that was his vision of eternal progress, and it means eternal chaos as well. It's eternal. Mike wanted to shake things up all the time. He was never happy to leave something alone, and so that's why I think he was the great Gatsby at the feast of ideas.
Yeah, I mean, you're bringing back great memories of conversing with him at our old EVA Institute events years ago. But we've been speaking with Don Chu. Thank you, Don, for joining me on this very enlightening and enjoyable discussion. I appreciate it.
Thanks for having me, Greg. It's been great fun.
You have been listening to Create More Value, sponsored by Fortuna Advisors, and I am your host, Greg Milano, founder and CEO of Fortuna Advisors. I hope you have enjoyed this episode. Fortuna Advisors helps companies with strategy, capital deployment, business management, corporate culture, and incentive compensation, all aimed at driving top quartile total shareholder return and the equivalent for private companies. To learn more, contact us at info@fortuna-advisors.com.